We had another epic rally on Wall Street with the S&P 500 closing higher by more than 1% and over 80% of its components closing in the green. Not only that, but if you added today's gains to yesterday's gains, this is actually the best two-day rally after an FOMC rate decision since dating all the way back to 1970. Not only have the last 2 days been strong, the whole month of July has been strong. And in tonight's video, I'm going to show you a number of statistics where if you go back throughout history and look at months that are as strong as the one that we're in right now, we've actually had continued strength for most of those throughout history. So who knows, maybe we've got more in the gas tank from this moment forward. We'll also take a look at how this has affected our posture in the various sectors and indices out there. And then in tonight's trade application example, I wanted to pick on a stock from China that was actually down today for a bearish trade idea moving forward. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 28th, 2022. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel, click subscribe on that channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. We'll also let you know which stocks within the S&P 500 are giving you overbought and oversold cluster signals at the bottom of those emails. We're also heavy users of Twitter. My handle is @BrandonVanZ. If you're not doing so already, I would encourage you to follow me. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And what a glorious sight this heat map on the S&P 500 is today. Look at all that green out there. It's a thing of beauty. And the good news is we had a couple of big movers in the after-hour session here tonight as well, with Apple and Amazon firing to the upside very nicely. There were a couple like Roku and Intel that unfortunately were falling in the after hours, but remember they are very much afterthoughts in market cap perspective compared to what Amazon and Apple are. So that's a good sign for the broad-based indices, with us closing up over 1% today and up, several percent yesterday, and then potentially adding to that first thing tomorrow morning. I'd say we had a pretty good week for ourselves. In fact, I think I just saw on Twitter a moment ago from, I believe it was Ryan Dietrich, was saying that if you went back and looked at the response from the stock market to the Federal Reserve interest rate decision, and then you took that day and the next day's returns, that what we just experienced in the last 48 hours is literally the best two-day rally after a Fed interest rate announcement since at least 1970, so in my lifetime. So if this has felt pretty special this week, it is because it is quite rare what we just experienced. So we'll see if the good times can keep on rolling tomorrow with Apple and Amazon leading the way. But let's review what happened here in front of us today. You can see lots and lots of green out there. Microsoft was up nicely. We actually just took a swing trade on that in my factor-based swing trading class earlier this week, so we were pretty happy to see that follow through after it reported its own earnings here a few days ago. And then, as I mentioned before, Apple was up in today's session, but not a whole lot. It was only up 0.36%, but in the after-hours session here tonight is what you'll be hearing everybody talking about first thing tomorrow morning, where it's up several percent. Amazon as well. Amazon was a somewhat quiet performer in the normal session today, up just 1%, but it was up, I don't know, something like 12% after hours the last I checked. That's pretty impressive when you consider the fact that Amazon currently has a market cap of over $1 trillion. So to just tack on 12% out of the blue is rather impressive. We also saw some good follow-through days there for Google, which was up approximately 1%. Tesla also showed some life today, up 2%. The one kind of standout there, I was kind of joking about this on Twitter here this afternoon, was those poor old shareholders at Meta/Facebook. They must be looking at all the big tech giants around them and seeing shareholders showering them with profits after their earnings announcement and wondering, hey, what's wrong with us? And so we'll see if Mark Zuckerberg and company can eventually get that ship righted. But right now, of course, the concern with that company remains, what does the future hold for the metaverse? To go as far as changing your ticker symbol and your company name to Meta and Metaverse, you would expect that maybe this is going to be a big cash cow for the business. But so far, it's kind of been like throwing money, into a fire. Obviously, when you're trying to create a brand new area of e-commerce and really social life and different things like that, I'm sure it's going to have a lot of upfront costs that, who knows, maybe will pay dividends down the road. But what we know here in real time is that Meta was the rare big cap giant in the tech-oriented spaces that kind of sat out the rally here in recent days. They weren't alone. You can see that in the media space. Comcast and Charter also struggled mightily today. Comcast was down 9%. Charter was down 8%. So those were some of your worst performers here today. You did see that Qualcomm struggled today, down 4%, and Intel was actually down in the normal session. That was before they are falling even further after hours. Their stock will fall so much here tomorrow, in all likelihood, if these after hours moves hold, that their dividend yield will be 4%. Somewhat rare at Intel. About a decade ago or so, there was a 4% yield, and then a month or two ago, there was also a 4% yield. But Intel has not been a company that's offered a 4% dividend yield here for the last several years, with those exceptions. And so we'll see if it can get a little bit of support around those levels. But obviously, not treating shareholders too kindly after hours here tonight. You did see that some of the healthcare areas struggled a little bit. AbbVie, Amgen, Vertex, Gilead, some of those were down. On the flip side of that, you did have Johnson & Johnson, Eli Lilly, United Healthcare kind of balancing that out in the healthcare world. You did see that the vast majority of stocks in the industrials, vast majority of stocks in utilities, materials, real estate, consumer staples, consumer discretionary, the vast majority of those companies were up. You don't see a whole lot of red squares in those respective sectors there. And I think that bodes well, because in some of the cases, they were actually bad news. I'm not sure if this is Best Buy. Let me just check. No, that was Etsy. Etsy was up about 9%. But somewhere in here, you'll find Best Buy. And point being, yesterday afternoon, Best Buy came out with a guidance cut. And we saw what happened to Walmart the other day when they came out with their own guidance cut. The stock got hammered. Well, Best Buy did the same thing yesterday, and the stock was initially down below $70 per share in the after-hour session. But in the normal session here today, Best Buy actually rallied all the way up to $78 per share. They did stop their buyback program. However, they did maintain that their dividend is safe for now. So I suppose investors cheered that little news item on a little bit. But I think that's a good sign, kind of going back to what I had mentioned in the video on Tuesday, where this week feels a little bit different than what investors had experienced from the market in the first half of 2022, where if you just had a little bit of bad news, your stock was going to get punished mightily for that. Now we're starting to see companies come out and actually cut sales guidance, miss on earnings numbers, and a whole group of other things that are concerning typically for the market. And for the most part, they've held up well this week, and in some cases have rallied pretty nicely. So it does feel like the market participants feel a little bit more confident in this market all of a sudden, even though it is currently faced with some bad news. Should also point out Schwab had a heck of a day. Schwab was up 8% here today, so a nice move after they announced their own dividend increase here recently. We also saw some positive movements out of the solar-based semiconductor world, with Enphase Energy up about 7%, and then Solar Edge up about 5%. There were some bills being passed through Washington, D.C. that helped support those efforts with clean energy bills going through. That also helped support some of the utilities. one of the stocks that we did awfully well with in my top-down trend trading class today was Constellation Energy. This is a stock that we've held for some time, but it was up out of the blue here today, 16%. And again, a lot of that goes back to some of the bill that was signed there within the DC world when it comes to alternative energy and some of the resources that are going to be set aside for basically some of those bills that will be funneling themselves into these utility companies. So a lot of the utilities did perform quite admirably today, but especially Constellation Energy had one heck of a day, 16%. You don't see that every day for a utility stock. All right, let's go ahead and take a look here now over at the main part of the platform and check our breadth numbers. And we had, of course, excellent breadth today. That should have been readily apparent by looking at the heat map there just a second ago with all those green squares. But just to formalize it, you can see that I've got the S&P 500 pulled up here under the Market Watch Visualize area. And we had 410 stocks within the S&P 500 close in the green today. That was good for about an 82% hit rate. So, 8 out of every 10 stocks basically closing in the green today. It was a broad-based advance. Let's go ahead and pop on over to the charts now. And I wanted to bring up this chart 6D as I typically do whenever the markets move up or down more than 1%. And I wanted to start with this view, which is a little bit different than what I typically show you, because what I've done in this case is I've changed the normal 1-year daily candle chart to a 20-year monthly candle chart. So each one of these bars that you see down below here represent 1 month in time, not just 1 day in time. And the reason I did that is I wanted to point out something that I find to be somewhat fascinating. I don't know if it's going to be worth anything in the end, but I figured, you know what, it's interesting to me, so I'll point it out to the audience and you can do what you want with it. But where we stand right now in the month of July has been rather impressive, to say the least. Remember when I was with you on Tuesday, I was talking about how that day was just the second day of the month of July that had a sell-off of over 1%, just 2 days in the entire month, and how different that was from all the other months earlier this year in 2022. Now I could take that a step further, and we'll look at this here in just a little bit and show you how many days we've had to the upside of over 1% this month. Well, again, what we're looking at first of all is what the 1-month return is. And you can see this number off on the right-hand side here is basically showing us that so far in the month of July, the S&P 500 is up 7.58%. Now, we do still have 1 more day left, so that's not official numbers yet, but you can go ahead and check that for yourself tomorrow afternoon if you need to, and I'm sure David will probably touch upon it when he does the video this weekend as well. But assuming there's not some sort of huge plunge tomorrow in the market, which right now it doesn't appear like there's going to be because the futures are actually up based upon the aforementioned Apple and Amazon response to their earnings. So if anything, we might be tacking on additional percentage points to the upside tomorrow. But as of right now, we are up 7.58% on a monthly basis. And you can see that that is by far and away the largest green bar on the board here so far in this calendar year. We'd actually have to go back to this candle right here in November of 2020. So remember, that's not 2021. Remember how beautiful of a year 2021 was? But what made 2021 so odd is how consistently it was climbing that wall of worry. There wasn't really big movements along the way. It was just repeatedly going up, 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 and away. And that's part of the problem, by the way, for 2022, is because whether we know it or not, we were being trained by the marketplace for the entire 12 months of 2021 that stocks only go up. And of course, that is it gets dejected feelings once you get into a more normalized market environment like we found here recently. So, we of course pointed that out to you regularly in 2021 that was incredibly abnormal, the consistency of the move last calendar year. But we'd actually have to go back to November of 2020, so well over a year ago, nearly 2 years ago, since the last time we saw a month that is as good as the one that we are currently in the midst of right here, right now. The thing that I found interesting about this is we don't have a whole lot of these types of months throughout history. This is somewhat rare. It's not unheard of, but it is somewhat rare. If I were to get let's get a drawn item out here, and let's see, where am I at? There we go, drawing tools, and then go to a price level, and I just want to draw a line approximately where that is at 7.58. I could come in here and right click on that and edit it if I wanted to get it spot on. So let's do that. So let's go 5.8 there. And let's use black as a color in this case. And let me make this a slightly smaller line so that way we can see the bars a little bit easier. And so as I do that, that black horizontal line that I've just drawn on the chart right there will basically represent where we are right now with just 1 day remaining in the month of July, at least from a trading perspective. Tomorrow's the final trading day of the month. And gives you a sense of what the other elements look like when we've had those situations. Let me kind of expand this a little bit more because I want to make sure that we're pointing something out. So when we go back throughout history, and this is a 20-year chart that we're looking at now. So again, this is during most of your investing career. I myself started investing about 23 years ago. So most of my investing career is encompassed in this view that we're looking at right now. And if we were to go back and look at the various months, and obviously 12 months each calendar year, and so we're looking at, basically 120 instances here of data. So of those 120 instances, the only times that we've been able to get above where we're at right now on a 1 month basis is right here. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So out of 120 possibilities, only 10 of those months in the last 2 decades have been as aggressively strong as we are currently dealing with right now. Now, some of you are thinking to yourselves, well, yeah, that seems pretty normal because, of course, we've just had a really tough start to the year. Remember all those statistics that we brought to your attention at the end of June, just 1 month ago. It feels like a lifetime ago, but just 1 month ago, people were shaking in their boots, so to speak, right? There was a lot of nerves in the marketplace because we had just got done posting the worst 6-month start to the year since 1970. So that does happen quite often, where when you have the most extreme sell-offs, you have the opportunity for the most extreme bounce backs because of the kind of the notion of the old dead cat bounce philosophy. But what caught my eye in this particular instance, so that's not particularly eye-opening. Even in my own head, I would have kind of guessed that is a possibility. But what did kind of change my mindset was looking at where those big months occurred and asking myself, were those near the bottoms or near the tops of recent moves? And if we go back, we can see that it was near the bottoms that we had these really big moves that were more than 7.5%. We had one back here in October of 2002. Remember, that was after the dot-com bubble. We didn't actually get our official bottom until early the next year when you saw this other one right here. But the good news is from October of 2002 to where we finally got a bottom early in the spring of 2003, we didn't go down any further. We basically just went sideways. So had you been a buyer of stocks after the market went up 7.5% that particular month, you wouldn't have really been hurt any further compared to what damage you had already taken throughout the dot-com crash that happened in 2000, 2001 prior to that. And then on this one, naturally, this was basically kicking off that big rally that we eventually had. These lines get skewed here because of the numbers get bigger and bigger throughout time, so it's a little bit harder to make sense out of it. But just take my word for it that right here in April of 2003, despite the market going up more than 7.5%, it would have been a brilliant idea for you to be buying the market hand over fist, because you basically had, after that moment in time, basically 4 straight years of gains before things started to get a little bit chaotic once again here in late 2007. We all know what happened in 2008, and notice the next time we have a green bar above that black line. That happened in March of 2009. And if that sounds familiar, it's because it should. That was the bottom. You can see that there's a low tag associated with the exact candle right there where we kicked that off. Well, what was kind of cool about that particular moment in time is that it wasn't just March of 2009, the bottom of the market, that had a 7.5% move for that full month. But the very next month, you had a repeat performance of it. And that's the only time in this 20-year span where you had back-to-back months that were up at least 7.5%. And, you know, some people, once the market's already up 7.5%, they tell themselves, well, I can't possibly buy the stock market right now. It's moved too much without me. But what we are seeing here is that doesn't seem to be the case with these instances that we've identified historically. Here's another example of it right here in September of 2010. That candle right there, you can see that it would have given you about 6 months worth of gains had you bought the market after it went up 7.5% that month. We then had that spillover in the summer of 2011 with the U.S. Government downgrade. So we had like 5 months in a row to the downside there, but that set up yet another opportunity here in October of 2011. And so I remember it well. That was my first year working here in Utah at InvestTools. I had worked for TD Ameritrade at the headquarters in Omaha for a few years prior to that, but then I got the job to transfer out here to Utah. And it's when I first met David Settle, of course. But that was quite the chaotic summer because, you know, people were just selling stocks left and right for 3 or 4 or even 5 straight months there. But then it all kind of culminated in a massive rally there in October of 2011, where the market was up 10.77%. So that was a huge rally. So then you might be asking yourself, well, what would have happened if you bought the market after it was up 10% in a month? Let's say you were on the sidelines right then, and you just watched stocks go up 10% without you in a single month. Most people, again, would think to themselves, well, I can't possibly buy now. The move's already been made. Well, this suggests the move wasn't made. That would have been an excellent time to be a buyer of stocks. And then we fast forward a few more years. So we'd have to go from 2011 all the way here to 2015. So 4 more years before we got another 7.5% month to the upside. And that was in October of 2015. And just before then, we had 2 months in a row to the downside. And again, we look at that particular candle and ask ourselves, would have we been hurt tremendously had we bought the market after it was up over 7.5%? This one, you would have gotten a little bit more dinged up because you did have 1 month of gains immediately afterwards, but then you did have 3 months in a row to the downside. So that one, while it doesn't look like much in hindsight, knowing what we know now, in real time, that probably would have felt a little bit more chaotic to you because you would have given up the gains of that month by the time it was all said and done and then rallied again. So that one was a little bit more borderline, whether it would have been a truly, great moment to be, investing in the market. But then we fast forward again to this date right here in basically January of 2019. And remember, that was following that really big Christmas sell-off in 2018. It was the worst holiday season for stock market participants, I believe, ever, or at least in a very, very long time. So that was a very rare instance where the holiday season was terrible for stock investors. But the first month of the next year, in January, we had a 7.5% move back to the upside. And you ask yourself, had you been a buyer of stocks at that moment in time after that move, would have you been benefited? Yes, because the market basically went up for that entire rest of that calendar year before we then, of course, got into coronavirus, which nobody would have been able to predict in advance. But that then sets us up for our next couple of 7.5% months to the upside. This one right here is the biggie. This is April of 2020. So remember, the coronavirus wipeout happened late February and then pretty much the entire month of March. So then immediately after that, we had a 12.68% rally. That's the biggest one in 20 years, that April of 2020. And remember, that's when a lot of people started to get invested in the market. I tweeted that out the other day, that some of the statistics suggest that 15% of today's market participants started trading for their very first time in 2020 or later. So in other words, we've got a lot of newbies in the market right now. But, those newbies, if they were buying when they got their stimulus checks initially, actually saw some progress right out of the gate. That doesn't always happen. Sometimes you get dinged right away. When I started investing back in January of 2000, I got dinged right away because the dot-com bubble was about ready to unfold in a big way. But folks that started spending their stimmy checks in the market probably had several months of upside potential there, and it started off with a bang of a 12.68% move to the upside. And you ask yourself again, after missing a 12% up move in a single month, a lot of people probably would have thought to themselves, I better be cautious. I better not buy the market right now because it's gone up too much without me. I better wait for a pullback. Well, you can imagine how difficult that would have been for people to absorb, because had they waited for a pullback back into that prior month's candle, you're still waiting today. We still have not gotten back to there. You went up several months in a row after going up 12.68%. And then if that wasn't enough, later in the year was the one that I already mentioned, November of 2020, the market was up 10.75%. Remember, that was associated with the Pfizer vaccine news. That also happened to be the month of the U.S. presidential election. And again, you ask yourself, would have that been a good time to be buying stocks? Well, knowing what we know right now, with 2021 being one of the most persistent and consistent market moves to the upside ever, yes, even after the market went up 10.75%, you would have been nicely rewarded within the coming year for buying. So I found that really interesting, because it's not interesting that we're getting a bounce after a really aggressive sell-off, but when we get this aggressive of a bounce, history has suggested that's actually been a good time to start putting more money to work, not less. Now, countering that kind of mindset is the mindset that the valuations in prior market moves are different than they are today. Let's step on over here to the internet a second, and I wanted to kind of point out the Shiller PE ratio that a lot of market pundits will use to try to judge whether we have value in the market or not. This is a cyclically adjusted PE ratio across the entire market, so it gives us maybe a broader view as opposed to some of the wonky stuff that can happen on a one-off basis in weird years like the coronavirus years and different things like that. But what I wanted to point out is that this is updated every day, and the current Shiller PE ratio is 30.55. And for those of you that know anything about PE ratios, you'll know that that is an extremely high PE ratio. And the nice thing about it is you can see right here that it's graphed out as well. And where we were at earlier this year, before we started this big kind of meltdown, or maybe this would have been late last year. It was either late last year or the beginning of this year. It's hard to tell on this chart. But point being, where we were at right here was basically the second most expensive stock market in history, or at least going back to the 1860s, according to this graph. The only other time that the stock market was more expensive than where we were at the beginning of this year was during the dot-com bubble, where you can see that the Shiller PE ratio was way up here, almost at 45. So other than that really oddball time period, the dot-com bubble, where people were just buying stocks because the internet opened up and many people opened up their very first brokerage account. I've got my hand raised right now. It was all of us schmucks out there that were opening internet brokerage accounts for the very first time and dumping our money into the market that learned a painful lesson in the coming years immediately thereafter. So other than that oddball time with the internet opening up for the average Joe, the stock market throughout history has never been as expensive as it was earlier this year. And so some people might think to themselves, well, if we've just had the worst 6-month start to a year since 1970, then surely the PE ratio must look attractive now, right? Because the PE ratio, of course, has two elements to it, price and earnings. And if earnings are holding up, but price is going down, then that results in a lower PE ratio. We did get that, so you can see that this line has fallen from, I don't know, somewhere up here at about, let's call it 37, down here in real time to 30. So that is a reasonably sharp drop in the PE ratio. But as you look at it from the grand scheme of things, we are still at some of the most elevated valuations in history. At this point, the only times the market's been more expensive is at the beginning of this year. You also had it more expensive there maybe in like 2018 briefly, and then the only other time would have been, and actually this is not the case. I was going to say Black Tuesday, but to my eye it looks like Black Tuesday's valuation was actually a little bit lower than 30.55. So you basically have the dot-com bubble earlier this year and then a brief time back in probably 2018. Other than that, the market has always been cheaper than where we're at right now. So you can see why this is such a tough business, because on the one hand, you're looking at statistics from just a purely price perspective and saying to yourself, well, we've got some evidence here that this market has gotten very constructive in a hurry, and history has suggested that these big violent moves have led to further gains. On the flip side of that, you know, the devil on your other shoulder, so to speak, is whispering in your ear that valuations are still extreme right now, and there's still a tremendous amount of froth out there. So it's going to be interesting to see how things shake out, but I wanted to share some of those insights with you here tonight. Spent a little bit more time on that than I had preferred, but when it's kind of unique and something that we don't talk about a lot, I kind of like to spend a little bit more time on it as opposed to the same old, same old. So forgive me for spending a bit of time on that here this evening. While we're over here on the internet, let's go ahead and take care of this. Thank you to all of you that help support this market outlook video. And the last time I did the video there on Tuesday, 104 of you came out of the woodwork to click like for me. Remember, as long as we're up and over 100, I will plan on doing a full-length video. And in this case, we were just 4 over that metric. So you last 4, whoever you were, congratulations. You're the reason I'm still talking right now. We wouldn't have even had that conversation a second ago had we been at 99 likes instead of 104. So thank you to all 104 of you, including Prickly Trader. There's Brandon Walker. There's Aviva and Greg and Ron and David and Dave and Jerry, Roger, Deborah, Sarah, Carl, Roger, Dennis, Paul, Gerald, Kenneth, Dale, Kirk, Surendhar, Margie, Ray, SW, HR, Tom, Adrian, William, Austin, Craig, Sudhar, Ken, Irene, Dave, Terry, Damon, Paul, NZ, Leah. Can't get to all of you, Teddy and Irene and Fred and everybody else. Thank you. I like to at least rattle off several names so you know that I'm seeing you coming in with those notifications, and I appreciate all of you. But it does chew up a little bit of time there, but sometimes it's kind of fun to see your name in the light, so to speak. So thank you to all of you that help support us. Also, earlier today, I taught my question and answer session. So if you're interested in that content, feel free to go over to the trading rooms area of our website if you're a premium member and check that out. And David taught his ETFs class, portfolio management with ETFs class. And tomorrow he'll be teaching his technical analysis class. While we're over here, let's also take a brief view here at the factor selector tool. And you can see that low volatility has led the way now for the 6th week in a row. And while that the difference between the factors is probably tightening up right now while the market is bouncing, I think that today low volatility probably fared pretty well because the utility area did so well. Remember, utilities are a big chunk of low volatility, and so they might be able to retain the lead once again when I redo the numbers next week. But for right now, we still have low volatility leading the way, despite what has been, as we discussed before, one of the best months in the last 20 years, right? And normally you wouldn't think that in one of the best months in 20 years, that low volatility stocks would be the leader. And that's kind of what we're seeing right now. On the downside, value has fallen out of favor. And the reason for that, from my perspective, is because oil and gas stocks have stopped outperforming at such a dramatic degree. Notice this blue line, if you were to track it backwards, back here in May, value was number 2 for several weeks. And that was when, of course, oil and gas companies were doing quite well. Now that they've fallen out of favor, its value in general is having a harder time keeping up with some of the other areas of the market. All right, let's get back on over here to the charts. Let me flip this back on over to the 1 year, 1 day view, because I wanted to point this out briefly as well. On Tuesday, I was talking about how that was only the second day of the month of July, with that one right there being the only other one. So those two were the only 2 red bars that stretched down below that blue horizontal line, meaning that we had a 1% down day. Notice all these other red bars, these really ugly red bars in all of the other months earlier this year. So we've had a relative lack of selling in the month of July, and at the same time, we have not had a lack of buying. We've had a robust amount of buying, and if you were to look at today's candle being up over 1%, the S&P 500 was up 1.21% to be exact, so it stretched up and over the blue line on the upside. That's 1, 2, 3, 4, 5, 6, actually, I can't count that one, can I? Yes, I can. That was July 1st. So that was 7. This one might have been like 0.99%, but let's just count it for fun. So let's just say that for giggles, we have 7 1% or more up days in the month of July, and 2 of those were more than 2% up days. So 7 versus only 2 days where the market was down 1% or more. So that, again, gives you the impression that the bulls are pretty serious right now. This is not just some sort of a a joke that they finally stopped going lower. They're actually showing strength. It's not just that they stopped going down. They're actually showing strength to the upside right now. Whether that continues, we'll all find out. But I just want to stress that because I think that the attitude of the market is that it's still in a precarious psychological place from a sentiment perspective. And I'm just as guilty of that, by the way, because I still have my concerns about this market. But the evidence in front of us does show us that the bulls are being very resilient, quite strong, and maybe they have what it takes to actually turn this ship around and actually make a trend-changing type of a move here. So it's got to start somewhere, and the stronger the start, the more energy that move possesses to kind of push it forward, as we saw with the months earlier when I was showing you that breakdown. All right, let's go ahead and take a look at our foregrid now. And to nobody's surprise, we have strongly bullish postures across the board. Now, I wanted to come back to something that I had specifically pointed out to you guys on Tuesday's video because it did come to fruition. Remember on that video that I did for you guys 2 days ago, on that day, the NASDAQ had fallen for its 3rd day in a row, and it produced this light pink background color because that green line had slipped just a little bit below the upper reversal zone. But I was telling you flat out, I wouldn't read too much into that. And I was telling you that with a good day in the market the following day, which would have been Wednesday, you could easily see that weekly bearish posture go back to strongly bullish posture. That's how close it was, because the line was at like 77 that day. And you can see exactly why I said that in advance, because that's exactly what happened. Now, it's not that I was predicting that the next 2 days would be this aggressive. I certainly wouldn't have. But the point of me, showing that to you is to remind you not to get too, turned against the tide, so to speak, if there is other evidence in favor of the posture staying in the other direction. And I was pointing out how we still were trading above a rising 30-day moving average that day, despite the posture kind of coming into conflict with that. So that is case in point right there, where you've got to be careful just completely going in a 180-degree direction in the opposite direction when you see one single technical indicator tell you something. So the good news is most of you probably weren't thinking that way, because we did have 3 out of the 4 charts that remain with their strongly bullish posture even on Tuesday. The only outlier there was the NASDAQ. So hopefully you guys were wise enough to say, well, that's probably just a very fleeting posture for the NASDAQ. The rest of the market appears to be holding up just fine. So here we are 2 days later, and as I mentioned before, we've had basically the best 2-day after Fed announcement session since 1970. And you can see we've made some tremendous progress here on the charts. Not only are all 4 of these charts strongly bullish according to the intermediate green line on the market forecast technical indicator, but all 4 of them have green 30-day moving averages currently as well, telling us price is above a rising moving average. Not only that, but we've actually broken through to some somewhat more important levels. We still got work to do, and that will always be the case. Remember, as long as you're not at all-time highs, there's always some overhead resistance from the past that you have to work with and try to get through. But what I wanted to point out is that I thought the last 2 days rally was rather impressive and important, because we were able to get up and over this prior resistance right over here, which in this setup kind of gives us the sensation that this is a bit of a kind of almost like a bull flag type of a breakout that we're going through right now. The other thing that I think is useful is, let me get my drawing items out again here and use a price level. You will oftentimes hear me refer to this concept in technical analysis, that is that old resistance becomes new support, and vice versa. So notice back here on the S&P 500, back in kind of mid-May time period and also late May time period, we were basically bumping our heads down on top of that blue horizontal line. So it looked like it had the possibility of forming a double bottom, and we actually had a pretty nice rally immediately thereafter that probably caught a couple people in a little bit of a whipsaw action, because you actually surpassed the midpoint of that double bottom. That's a story for a different day. The point that I wanted to make is there was support right there at that blue line. Well, eventually that failed, right? And that will happen. That's why we're always constantly reevaluating the charts. And in this particular case, the market had its way and the bears took over, and we pushed directly through that blue horizontal line somewhere there in kind of the middle of June time period. Well, notice by the time we started to shake this out, we got an oversold cluster signal on the daily candle chart. And remember, that wasn't it. I'm not showing the weekly candle charts right now, but remember how much of an emphasis I put on the weekly oversold cluster signals on both the S&P 500 and the NASDAQ composite during that exact same time period. Remember, for the S&P 500, if my memory serves me correctly, it was only the second oversold weekly cluster that we had in a decade. So I was really trying to alert you guys of that, and hopefully some of you at a minimum took some of your bearish exposure off the table and maybe even added some bullish exposure, even though it didn't feel good to do so. But markets were so extremely oversold, it made sense to do so. But anyway, point being, we did get a cluster right there, and we rallied back. And notice where we rallied to. We rallied to that blue line once again. We failed there. We pulled back again. We formed a higher high, or I should say a higher low. And then we came right back up to that blue line again, where we formed an equal high. So it acted as resistance a second time. So over here, it acted as support twice. Over here, it acted as resistance twice. And then eventually, here in the month of July, we finally were able to get the bulls get their act together and move up and through that resistance area. And wouldn't you know, here a few days ago, we kind of rounded the corner, we broke out, and we retested that area once again, and that was what we used as a launch pad higher. And now all of a sudden you're looking at this and you're saying, well, there's a low, and there's a low, and this is potentially a low. Those are all higher lows. And then you start looking at the highs, and you're like, well, that's a high, and that's a high, and that's a high. You actually have a legitimate series of higher highs and higher lows right now. The problem, of course, as I alluded to before, is that you still have other overhead resistance. So this is a start. It doesn't necessarily guarantee that it will kick off this massive uptrend, because there will still be folks that felt like they got trapped in the market over here. You know, as I alluded to before, some people might have bought the market right here on this candle on May 27th because we broke out between the midpoint of that W pattern right there. And wouldn't you know, that was about the worst possible time to be buying the market, because you went sideways for a week and a half and then you just torpedoed lower. So there were still probably some people that are trapped in the market from where it was trading back here late May, early June. And so that has the potential that if we get into that kind of area here, let's say within the next couple of weeks, it's possible that these folks who initially felt trapped will now be relieved to get out at break even, and they will sell their shares, and it's that extra supply of shares that could very well end up causing a new level of resistance up at that area. So that's one thing to be on the lookout for. But, you know, obviously every scenario is a little bit different, so there's nothing that's ever going to be textbook in nature. But I did find that to be very interesting to me, to see the idea of support becoming resistance, becoming support once again, and now bouncing up and away from that area on the S&P 500. Let me get rid of that item, that drawn item, so that way I don't have to have that staring me in the face in the future. All right, so I mentioned before the S&P 500 was up 1.21% today, so an excellent day. The Dow Jones was also up over 1%, and remember, the Dow is oftentimes a laggard on a day like this, so they were only up 1.03%, but that's still a good day for the big blue chip index. And then down below here, you'll see that the NASDAQ Composite was up 1.08%. So somewhat strangely, they underperformed today. Part of the reason behind that might be what I mentioned before with Meta. Remember, Meta is going to be a big part of the NASDAQ Composite. So some of those social media names might have kind of put a lid on the market advance that you're seeing in some of the other areas there. And then over here, the Russell 2000 was up 1.34%, which actually led all markets here today. So the low size category starting to show its worth here all of a sudden. You'll notice that all of the green lines are in the upper reversal zone now, with the S&P 500 just barely getting there at 80.14. And so that is another sign of strength. This is not just your everyday run-of-the-mill amount of strength. This is good strength that we're dealing with here to get us all the way back up into the upper reversal zone. Now remember, in 2021, that was not that big of a deal. But let's put some, perspective behind this for a second. All you have to do is look at the green line on each of these four charts and ask yourself, when was the last time you saw the green line in the upper reversal zone? And I have the answer at the ready. And the answer is, it's been more than 3 months. And the reason I know that so quickly is I can look at all four of these charts and quickly glance at the green lines underneath all four of the charts. And these charts all got into the upper reversal zone basically today or yesterday. And that was the only times they've been there in 3 whole months. So this is somewhat rare and very good strength that we are seeing here all of a sudden. You'll see that strength is so strong that you actually have an overbought cluster signal appearing here out of the blue on the Dow Jones Industrial Average. It is our only index that has that little red dot appearing because the green, the red, and the blue lines all closed in the upper reversal zone on the same day. And so we'll see if that amounts to anything. There's been plenty of times in the past where when you see overbought cluster signals early in the trend, it's actually a positive sign because it means that the bulls are serious. But with this one happening right around where we might have some anticipated resistance area, it's probably not going to be a cakewalk at the same time. So there's probably going to have to be a little bit of a battle between the bulls and the bears to see who's going to end up winning here. But at least we do have a lot of things to cheer here as investors all of a sudden in the month of July. Let's go ahead and do some 12 grid analysis now. And I'm going to go ahead and take a look here at our asset class 12 grid. And the background colors of these charts will tell you whether we have a bullish or bearish intermediate posture according to the market forecast technical indicator. If the charts are green, they're bullish. If the charts are pink, they're bearish. So as of this moment in time, we just have two pink charts on the board. The one in the lower right-hand corner is dark pink, telling us that we have a strongly bearish posture on Treasury yields. And that should not be lost on anyone because, remember, if there was a story to the first half of 2022, it was that interest rates were going up without abandon. They just kept going up and up and up and up and up. And it really caused a lot of concern for market participants because remember, it's been quite a long time since we've seen interest rates go up that quickly. In fact, I think it was setting some historical records in terms of how short of amount of time interest rates were rising, let's say like 100 basis points or something along those lines. So it was pretty aggressive what we had witnessed earlier this year. And the market didn't really know what to do with that. Remember, most of us haven't really been in a market environment like that before. We're currently dealing with the highest inflation rate since basically the early 1980s. And so, the Fed was throwing out in advance their intentions, which is we're going to continue to raise interest rates until we break the back of inflation. And so the bond market, doing what it does best, tries to get ahead of the Fed and sent the interest rate environment a lot higher before the Fed could even try to play catch up. But that seems to have all changed here recently. So it should be no surprise that since we've seen interest rates top out, which really happened here in mid-June, the stock market itself has responded much more positively. When interest rates were going up, 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 the stock market was going down, 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 down. Now that we're seeing the opposite and interest rates are actually falling pretty quickly, we're seeing the stock market rising pretty quickly. So you can see that relationship that takes place between those two macroeconomic effects there. And as of this moment in time, the 10-year U.S. Treasury yield is currently at its lowest level in over 3 months. Interest rates are actually down over the last 3-month time period, even though a lot of people would say the story of the year is how strong interest rates are. Yet right now, we actually are negative on a 3-month basis. So remember, on the Thinkorswim platform, you move that decimal point over to the left one to get your true reading. So 2.68% is where we stand here currently on the 10-year U.S. Treasury yield. The U.S. dollar also has a weakly bearish posture, not strongly bearish, but weakly bearish with that light pink background color. But that's one of those where I'd still want to wait to see a little bit more evidence that the trend is actually going to break. Kind of the same concept that I was sharing with you regarding the NASDAQ the other day. Because in this particular case, we remain above a rising 30-day moving average. So you kind of want to give it the benefit of the doubt because more times than not in 2022, the dollar has used a pullback as an excuse to buy it, not to sell it off further. And it's really kind of ratcheted to new highs, multi-month highs, every chance you've given it to do so. So right now, we want to be respectful towards that. But it is true that you've certainly seen a lot more selling days in the U.S. dollar since topping out here on July 14th than what we've experienced in most other times in the past. But, it is true that during this time period, you had a lot of sell-off days there on the UUP as well here at the end of May. And you can see that did not lead to some sort of devastating blow to the dollar. In fact, it was a reason to buy it because you eventually went back to new multi-month highs. So we'll see where it takes us. But right now, we've got a conflict because we got a green moving average, but we have a pink background color. So those need to be resolved moving forward. Remember, when the dollar is weak, commodities can be strong. We actually had a long conversation about gold today in my question and answer session. You can see gold is kind of breaking out of its shell a little bit here today, up 1.22%. But the problem is gold has made these moves back to the falling 30-day moving average in the past, and it's usually failed at those levels. So it's nice to see that we're finally getting that dead cat bounce, but until it actually can stay above its moving average for a considerable period of time, I think I'm going to remain a little bit skeptical towards it at this given moment. Oil was down just a hair today, but still continues to have that weekly bullish posture. Bonds did well today. Of course, that makes sense. When interest rates are falling, bonds tend to do well, bond prices. So government bonds were up 0.8%, foreign bonds were up 0.85%, and high yield bonds were up just over 1%. And all of them have strongly bullish postures and a moving average line that is currently green, telling us that price is above rising moving averages. In terms of what's going on in the foreign stock world, good things happening there as well. You can see that both EFA and EEM closed higher today. Not as much as the United States, but nonetheless closed higher. And in the case of EEM, you were able to finally get above that moving average as well. Remember, I pointed that out on Tuesday, where that was maybe one of the flies in the ointment there, but that's been resolved in the last couple of days. With EFA, which tracks the developed foreign stocks, we've just seen a follow-through, a continued move to the upside. And you can see we have a green moving average there on EFA. So it seems to me that EEM still is a laggard compared to EFA, and I'll actually talk about that perhaps a little bit here when I talk about my trade application example. Before we get to that, let's take a quick peek at the US Sector 12 grid. And as we're looking at this, we can see green, green, green across the board. Even with communications. Remember on Tuesday, communications was the only chart that was not green. Today, we can scratch that one off our list because we're back to green on communications. And that's actually somewhat impressive considering the fact that on such a strong day like today, communications was actually the only sector that was down. It was down 1.14%, largely because of what happened to Meta. But because yesterday was such an aggressive day, so between Tuesday when it was a bearish posture and today where it was down again, we had this huge up day yesterday. So that's what's allowed communications to join the other sectors with that bullish posture. So that was the only one that was down here today, and all the rest were up, and in some of the cases up pretty violently. Notice what happened with utilities and real estate. Both of them up over 3.5% today. Again, kind of tapping into that strength that I referred to before on the factor selector tool with low volatility stocks surging here all of a sudden. All right, let's talk about our trade application example. And I'm going to come over here to just a normal swing trading one grid. And I'm going to pull up ticker symbol JD. And this is JD.com, and it's a Chinese company. And one thing that I was kind of kicking myself about after the market closed was realizing, oh yeah, this stock could very well trade in unison with Amazon. It is somewhat of an Amazon over in China. But I wasn't thinking that, unfortunately, and I placed the trade anyway. And so that's something that perhaps it will not work out, knowing what we know now with Amazon coming out after the bell with a huge blowout earnings number. It's possible that a lot of these online retailers will follow suit with Amazon tomorrow. So just be prepared for this trade, or any trade really, to fail, right? Our trades can fail at any time, which is why it's important to have diversification. But what I did in this case was a bearish trade, and it was just a simple short selling trade, so it was not involving the options market. But you can see here that today this stock was down 1.88% on a day when the S&P 500 was up over 1%. And they weren't alone. A lot of Chinese companies actually struggled today. If you look at FXI, which tracks the China large caps, it was down 1.29% today. If you look at KWEB, which is a Chinese internet-based ETF, it was down 1.7% today. And of course, we heard the news that President Biden spoke to Xi over in China here today, and perhaps some people had some negative takeaways from that conversation, and maybe that's why the Chinese stocks seem to struggle on a relative basis compared to the U.S. stocks here today. So I thought, well, let's try to take advantage of that and get another bearish trade on our books, since most of our trades right now are bullish and we've had a good run out of them in recent days. Let's try to add a few more bearish trades here and layer them in to help support that balancing act that we always have to consider as traders. And so with this one falling today, you can see that its background color changed from blue to pink, signifying that we now have a bearish near-term posture. And you also see that the moving average changed from green to red, which in this case means price is back below a falling moving average. Now this one does have earnings coming up on August 23rd, but that gives us 18 trading days, not calendar days, but trading days to be in this. And I used a basic kind of bracket order for this one. So if it goes up above 65, I'll be stopped out On the other hand, if it comes down here to about, I don't know, 59, 15 or somewhere in that general vicinity, then I'll be locking in gains. So I sold short this. I sold this even though I didn't own it before. And now I have a negative 100 shares in my account. And if it goes lower, I benefit because I can then buy that back cheaper and capture the difference between where I sold it first and bought it back second. But I will want to get out of the trade for sure before this earnings announcement here. So if the stock ends up just going sideways, don't be surprised to see on Telegram me just saying, hey, I had to get out of this trade because of earnings. So if you're a premium member, remember you can join our Telegram alert service. That way you can be notified whenever David and I are placing these trades. So that's what I had for you here this evening. I appreciate you checking it out as always. If you got value out of the conversation tonight, whether it was value from learning that Chinese stocks underperformed today, or value from knowing what has happened historically with 7.5% 1 month moves to the upside, or any of the other conversation I gave you here this evening, I ask one simple request. Simply click like for me there on Twitter. As long as we're up and over 100 likes, by the time I'm scheduled to do this video again on Tuesday, I'll plan on doing another full-length video. And if the like count is under 100, then I'll just do a 15-minute version only on the indices themselves. So thanks again for checking this out, and I'll see you all next week. Take care, everybody. Bye-bye.